Yes, we're at Washington State, University of Vancouver. My name is Brian Barnhart. These are my colleagues.
Rachel Faulkner.
Eric Wynn.
Oleg Vasilek.
And Tristan Mudd.
And we're here today to present on Lithia Motors.
Lithia Motors began as a single Chrysler dealership in Ashland, Oregon. It began trading in 1996. Now, Lithia operates 139 stores in 15 states under the Lithia and DCH name. They were ranked number 8 by Auto News for their new car sales in 2014, and they were ranked number 1 for their total dealerships added in 2014. As we can see, Lithia has experienced high volatility in their stock prices. Their 52-week range is $72 to $126. This is because the stock is highly cyclical and is responsive to these market swings, such as the recent correction that we just experienced. Lithia generates revenue over a customer life cycle. First, the customer will buy a new or used vehicle. Import vehicles bring in the largest profit margin of their new car sales at 42%. Lithia has an advantage by offering both new and used vehicles because it allows them to sell to a broader customer base. It increases their brand mix, and it also gives them a competitive pricing advantage through trade-ins. The life cycle continues through financing and service packages. In 2015, 77% of their cars were sold with financing options. Lithia plans to focus on increasing their sales through used cars, and this is because there's a much larger market for used cars as well as higher profit margins. Lithia also has a strategic positioning in how they have clustered their dealerships. Most of their high competitors are in eastern and southern states. This allows Lithia to have a strategic advantage in states such as Oregon and Montana, where their top competitors are not present. The auto industry overall is a highly fragmented market. The top 10 dealers only own about 7% of the total market. Lithia's biggest opportunity for expansion is through acquiring small individual dealerships. These small dealerships have high barriers to entry to expand into the larger dealership arena and also have high competition. Here are the demand drivers that we've identified as the auto industry. The top driver is consumer confidence. Now there's many different pieces that go into consumer confidence, such as the GDP, the unemployment rate, the cost of credit, and also we evaluated oil prices. For our research, we found that oil prices, and if everything else is equal, they really only change the mix of vehicles that is being sold. Overall, Lithia has a high business advantage in their growth rate compared to their competitors. They have fueled this growth rate through their organic growth, through increased efficiency and economies of scale per dealership. They've also maintained this growth rate through their acquisition strategy by buying with low prices and with low debt. Lastly, they have 2 growth strategies in 2 different markets, the metropolitan and rural, through Lithia and DCH.
So here's some of the key ratios that we benchmarked against AutoNation. We chose AutoNation because they are their primary competitors here in the market. You can see that the return on assets has averaged higher than AutoNation's, and between the periods of 2010 to 2014, they had an average growth rate of 5%. Days sales outstanding has averaged lower than AutoNation, but however, in this area, they did show an upward growth rate of 10% per year. And with current ratio, you can see that they maintained at 1.3. However, they also have a downward growth of nearly 8% in this area, but despite their downward growth in the current ratio, Lithia has managed to maintain their quick ratio at 0.3 consistently throughout the years in order to maintain that liquidity. Revenue. Lithia's revenue is significantly lower than AutoNation's at $3.5 billion versus $15.7 billion. However, I'd like to point out that Lithia's growth rate is substantially much higher than AutoNation's or the industry's at 26% per year. Net profit margin has consistently been aligned with the industry average. Days payables outstanding is consistently lower than AutoNation's. Total asset turnover ratio has been consistently higher than AutoNation's, except for 2014, in which AutoNation was able to catch up to Lithia's total asset turnovers. Return on equity is lower, obviously, than AutoNation's at 16.38. I'd like to bring out another point that their growth rate in this area is at 12% versus AutoNation's at 16%.
So we use a few different valuation methods to come up with the target price, expected target price at the end of 2016. We used discounted cash flow, and we used two relative valuation models. The first one is our enterprise value over EBITDA, and the second one is a PE multiple. We've weighted these, and we've given the DCF model 80% and 10% to the other ones. So one of the first things that I want to point out is that we only included 2017 through 2024 in our discounted cash flow model because we're only concerned about the future cash flows in order to project our target price at the end of 2016. And some of the assumptions that have gone into our performance in our Excel model that have driven our revenue are acquisitions, car sales, nationally, organic growth, and price inflation. So we're projecting that that Lithia is going to acquire 8 dealerships per year during these periods, and that national car sales is slowly, gradually going to decrease from 4% to 2.5%. We're also we're projecting that price inflation will stay at 0.5%, and that organic growth is going to gradually decrease from 5% to 1%. And as you can see, this affects our sales. Our sales growth decreases from 11% in 2017 to 5% in 2024. So we calculate the net present value of the free cash flows and using a WACC of 7.62%, and then we subtract the debt and divide it by shares outstanding to come up at a share price of $118.44.
For the discount rate, we use the capital asset pricing model to find the cost of equity. We ended up using a 1.75 as our risk-free rate, a beta of 2.18, and for the cost of debt, we ended up with a 2.2%. At this point, though, we do want to make a notation that in our report there was a calculation discrepancy that we found. In our report, there was a WACC of just over 8%. After the calculation, that was a 7.62%, driving the discounted cash flow target price up a little bit. For the relative values, we ended up with a price to equity, or price to earnings, and a enterprise value over EBITDA. Those ratios, the PE produced a target price of $129 with a EV over EBITDA target price of 106. Combining all of these together, we have a target price of $118 as of December 31st of 2016.
The risks I'd like to talk about today are going to be on corporate governance, finance, and economic risks. Currently, Sidney DeBoer is the sole managing member of Lithia Motors and holds 52% of the Class B voting shares. This, coupled with his son Brian DeBoer, who is the CEO of Lithia currently, gives the family complete control of the company. The risk here is that there may be potential conflicts in interest between what the family wants and what shareholders are most interested in. In addition, in an effort to secure additional financing, Lithia has pledged 1.8 million shares of their Class B stock to U.S. Bank to secure for collateral on loans. Now, if this is foreclosed upon, this is going to have a significant difference, a significant change in the ownership of Lithia, which is going to cause a trigger of a breach in certain contracts, covenants, and agreements with manufacturers. Now, the auto industry is cyclical and subject to consumer demand. With prolonged down periods such as those found during a recession, they have a material effect on the new and used car sales. Recently, the states of Alaska and New Mexico, which make up approximately 7% of Lithia's revenue, have been declared as a state of recession. Additionally, Texas is showing a decline, and as you can see by the graph up here, we're also showing an increase in default rates within auto loans. Currently, Texas has had a double-digit increase of 14.7% over 2015. North Dakota, notably, only 2% of their revenue. However, they've had a 47% increase in auto loan defaults over 2015. Gentlemen, this is the conclusion of our presentation. I'd like to open this up for questions.
When you started to talk about discrepancies in the report, I didn't think you were going to talk about the weighted average cost of capital. I thought you were going to talk about your target price, because in your report it's 103 and now it's 118. What happened to change that?
So the weighting with that, with the discounted cash flow, the reduced WACC actually increased the target price up to, I believe it was 118. And then with the weights of the relative values, which we had at this 10%, that solidified it both back to 118, because they actually both came out to about the same within a few cents.
So your target price is 118, and the current stock price is low 90s or something, right? So that would imply pretty good upside in the stock price, but you also identified some pretty material risks there at the end to just the kind of underlying fundamentals. How do you balance those two considerations when you're making your recommendation for the stock?
With the risks that Lithia has, it's very common for a very cyclical stock like that to have similar risks. They're very highly leveraged, so they are sensitive to different changes in the markets. And although they do have risks as far as the corporate governance and the financial and economic risks, over a long period of time, they've done a very good job of managing those. When you look at their loan covenants, they have a required current asset ratio of 1.1 is required, and they're able to continually stay ahead of that. In addition, in a time in the past where they did have a difficulty in meeting the loan covenants, they were able to renegotiate without any material differences in the finances.
Is it safe to say that there's a fragile consumer out there that's living on sensitivity to interest rates, and these default rates are going in the trajectory that they are? The price of oil, it can't stay down forever. The product mix, you said there's a correlation between oil prices and is this the mix of sales? So oil prices are low, I presume that right now they're selling higher margin trucks and the things that would make a lot of money. And is there any kind of a strategy where the company is going to mix up the sale of used vehicles that have higher profit margins than, say, new vehicles? Just how is the company going to anticipate the sensitivity that the consumer may have through forward cycles?
Right now, Lithia's, from the customers that are purchasing vehicles from Lithia right now, only less than 10% of them are from subprime candidates. And with that, within the market mix that they have, especially here on the western coast, it's actually fairly limited. For example, Oregon had a negative increase in defaults. Actually, it was a 2.1% for the better for Oregon over this last year. So, in that aspect, although there are risks associated with the defaults, I think Lithium Motors is in a fairly good position to have a minimal effect on it.
You were one of the only teams to mention Takata in your report and reference 24 million vehicles or something like that. What's the effect to Lithia, either positive or negatively?
The increase in recalls will have a positive effect on them. However, this isn't something that's going to be very long-lived. This Takata drives to get these recalls all taken care of. One of the advantages that Lithia has is that it has a wide base of dealers here on the West Coast, and only those licensed dealers are able to go in there and actually make the repairs. Although there's fairly small margins on their on their receipt for making these recalls, it will have a minor effect, but it's not long-reaching over the course of several years.
Who pays for the repairs?
Manufacturers. But the manufacturers do, however, Lithia has to perform all the work, and in most cases, in some cases, it's not always profitable for the companies. It depends on the specific development.
So going back to your valuation model, if I recall correctly, you guys used an equity risk premium of 11%. Can you explain how you
So we had like the market expectation just historically is just about 11% over the long term. So that's what we were taking as the expected market return for that.
So you're starting there, adding, multiplying that times 2 point something times whatever the beta was, and then adding the risk-free rate. Is that the way to think about what you did, or how did the risk-free rate involve in that equation as well?
So the yeah. Okay, so for the risk-free rate, okay, so for the beta, we just multiplied that by the, oh, okay, I see what happened here, I apologize. The 11% is the actual market premium, so it's going to be the, I apologize.
It's alright, it just looked like that, you can see that it looks like the math is quite out. That's why I was kind of getting that, but that's, I think they follow up on it.
Yeah, I'll have to get back to you on that one.
Yeah.
What's the amount of sales that come from Oregon, and what will the impact have if the state of Oregon ballot initiative passes a corporate revenue tax?
Sales coming from Oregon are about 17% right now.
What was the rest of the question? Sorry.
There's a proposed revenue tax for corporations with sales over 25 million, a ballot initiative in November, 2.5%. Has that been factored into your risk assumptions?
I was unaware of that at that point in time, so that was not actually factored into the calculations. With that, though, that would drive the valuations down as the bottom line growth would be affected by that, which would affect the long-term free cash flows over time. So it's going to drop our target price with that.
You chose AutoNation as your primary comp. Can you get back around as to how you arrived at AutoNation versus Sonic, Ashbury, some of these others that companies been traditionally compared to?
With the exception of Oregon, AutoNation operates in every single market that Lithia operates in. In addition, with Lithia's growth rate, their projections over future years, we project that they may become much closer in revenue and a closer rival at some point.
Similarly, in that comp sheet, you had ratios in quick ratio and days sales outstanding, but there was limited profitability measures. Just net profit margin looks to be the only one there. I mean, what else would you consider when comparing profitability or comparability to AutoNation?
One of the other things we did look at, and that was in our reports, are operating margins. And currently, I believe Lithia was about 4.14%, and the industry average is 4.4. AutoNation was just below industry average. I think it's somewhere like 4.3, but I would have to get back with you on the specifics on this.
And then news to me, I learned that auto industry looks at the ratio of SG&A as a percentage of gross profit, and that was a new metric for me. How come you guys didn't cite that at all?
We actually use that in our assumptions.
Did you?
Yes,
Okay.
so 67.8%, and I believe it decreases from the 70% that's right now. So we use that in our valuation model and in our discount.
I'm sorry, I was just looking for it on here as in a comparable.
Oh, so-
My mistake, so I'm glad you addressed it.
So you mentioned that, given the fragmented nature of the overall industry, that long-term growth, consolidation of the industry is a good opportunity for Lithia.
1 minute.
You also mentioned that in the past they've had trouble with debt covenants and have some potentially capital structure changing things going on. How do you square those two things? So how do you evaluate their ability to grow through acquisitions given what appear to be some financial constraints?
Their ability to grow through acquisition has actually improved over the years, especially since those loan covenants. Right now, Lithia's projections are to grow through acquisitions by 20% of the return on equity. So they're doing a lot more cash-based acquisitions than they were previously.
classes of stock, and you spoke about the collateral in one of them. The Class B in particular, who owns that Class B stock?
Sydney Moore owns the majority of the Class B stocks. There's 2.5 million shares outstanding. 1.8 million of those shares are actually pledged, which are part of his to the U.S. Bank.
Fine.